Yeah, we had a lot of people register at the last minute.
Good. So expect lots of questions then.
Yeah. Okay, it is 10 a.m. here in Washington, D.C., and there are already 60 people joining, number steadily climbing, and so we're going to go ahead and get started. Good morning, everybody, and good afternoon or good evening from wherever you're joining. Thank you so much for joining us today for the Corporate Standard Training webinar. My name is Yelena Akopian. I am a communications officer at the World Resources Institute, and I'm very excited to be joining you today to be learning the fundamentals of corporate greenhouse gas accounting. I have a little bit of a cold, so please excuse my croaky voice, but I will be here as your go-to point person for any issues you may run into during the training. Such as technical issues. This is our first time using the Zoom webinar software for running this kind of training. So please, bear with us if we experience any new difficulties. But please do reach out to me. My email address is on the screen currently. If you have any issues with anything technical related to this training. So. This is a 3-day course that runs from 10 a.m. To 1:30 p.m. Eastern Standard Time on Tuesday, Thursday, and Friday of this week. As most of you know, we were originally scheduled for Tuesday, Wednesday, and Thursday, but we had to switch that around. So thank you very much for adjusting your schedules and joining us. I just want to note that the training will be recorded and all recordings will be shared with all participants. So if you have to miss a few minutes or even longer than that, don't worry, because I will be sharing trainings with you all at the end of each day. So I just want to go over some information before we start diving into the actual training. Okay, so I just want to share that materials and recordings are going to be available for download in both Google Drive and Dropbox. If you haven't downloaded the materials yet, I suggest that you do so. And so you can follow along with the training on your own computer, and you'll also have access to the files and practice exercises that we'll be going over during the training. And just so you know, at the end of each day, I will be dropping in recordings of that day's lesson into these folders, so you can access them on the same day, though there is usually a lag of a few hours between when the training ends and when the recording is available. But I'll make sure to let you know if there is any if there's any longer delays expected with that. So, and we'll also be dropping in answers to the practice questions into these folders at the end of each day. The next thing I want to let you know about is the certificate of completion. So if you participate in all 3 days of the training, or if you watch the recordings on days that you miss, you will receive a certificate of completion from Greenhouse Gas Protocol via email from me by next Tuesday, April 2nd. Another announcement is, as most of you know, with your registration for this webinar, we're also including a complimentary recording of the Scope 2 guidance training webinar. Since these are no longer available for the moment, we're not doing these live. We are offering this free recording to you all. And that is also going to be added into the Dropbox and Google Drive folders on Friday, March 29th at the end of the training. And so here are just a few more links for how you can download the guidance and a blog post with top 10 questions about the Scope 2 guidance. And also included with your training is a 20% off discount off the Scope 3 standard online training. So that the Scope 3 standard covers the entire corporate value chain, accounting for that. So there's more information available on our website, but if you would like to redeem your 20% discount and enroll in the training in the Scope 3 e-learning, please send me an email. And just so you know, this is not a live webinar. The Scope 3 e-learning is not a live webinar like the one that you're participating in now. It's something that is self-guided, and it's an online e-learning, and it does require Flash player, just so you know. So yeah, please send me an email if you're interested in learning more. Okay, and with that said, I'm going to go over and pass the training off to your instructor, Stephen Russell, who is a senior associate at WRI, and he's going to go ahead and lead you in the training. So please just wait a moment while I pass everything on to him. I do see there are a few questions in here already about the training. Where to download the training materials. I will absolutely answer those and send you all the links here in the Q&A as soon as I hand things over to Stephen. And I guess that's another important thing to note is that please ask us questions in the Q&A panel in the Zoom webinar interface at any point during the training, and we'll definitely be monitoring those and answering your questions in real time as much as possible. So I will be adding the Google Drive and Dropbox links in response to your questions in the Q&A panel. Thank you.
Great, thank you, Elena. Hello, everybody. Welcome to the trainings. I'm pleased and excited to be working with you over the next 3 days. I'll just take a quick look at the agenda. There are a total of 8 modules or lessons in this training. And at the end of each lesson, there are scheduled sessions for questions and answers. And I'll also be stopping periodically throughout each lesson to see if you have any questions. So please do feel free to send in a question at any point. In fact, I encourage you to do that, and I'll take your question then at an appropriate time. If I haven't answered your question during the presentation, I'll make sure to do so at the end of the presentation during those scheduled Q&A sessions. Okay. Today we'll be covering material through operational boundaries through lesson 4. We'll be looking at an introduction to the corporate standard, the principles of GHG accounting and reporting, which govern how companies construct their greenhouse gas inventories, and I'll provide an introduction to the topic of boundaries, which delimit which emission sources a company should include in its inventory and how those emissions sources should be structured within an inventory. Note that there is a break scheduled for Tuesday and Thursday, but the exact timing of these breaks will vary depending on to what extent we're on schedule. Okay. And before I officially start the trainings, what I'd like to do is help set the context for the trainings by explaining what the GHG protocol is and how its various standards relate to one another. So let me load the first presentation for the day. Okay, so what is the GHG protocol? The GHG protocol is a joint initiative between two non-governmental organizations, the World Resources Institute, which is headquartered in Washington, D.C., and the World Business Council for Sustainable Development, which is headquartered in Geneva. The GHG protocol was established in 1998, so 20 years ago now, and we're much more than simply an initiative between two NGOs. Fundamentally, the GHG protocol represents a partnership of businesses and stakeholders to develop and promote the use of consistent methods for greenhouse gas accounting and reporting. And that point is worth reiterating. Our work is really stakeholder-led to ensure that our products meet needs in the marketplace. And our work serves a broader mission, which is shown on this slide. The GHG protocol provides the foundation for more sustainable climate strategies, more efficient, resilient, and profitable organizations. And its standards are the most widely used accounting tools to measure, manage, and report on GHG emissions. I'll provide some statistics on the usage of GHG protocol standards later on. The GHG protocol has four general objectives. The first is to simplify and reduce the burden that companies often face in measuring and reporting their emissions. A second is to illuminate reduction opportunities and to enable market-based options in driving reductions. A third is to support management action and stakeholder reporting. And the fourth objective is to enable the credible, transparent, and consistent flow of information across multiple borders and jurisdictions. So, for example, between different companies or between different units of the same company. This slide provides some basic statistics on the GHG protocol, just to give an idea of its breadth and impact to date. So far, we've published 6 major standards and a range of sectoral supplements to those standards, and I'll provide an overview of those publications in just a minute. We've developed over 25 tools for calculating the emissions from various cross-sectoral and sector-specific emission sources, and we'll look at some of those tools in one of tomorrow's lessons, and that lesson is lesson number 6 on calculating emissions. The GHG protocol also produces a newsletter that's available from our website, and we highly recommend that you subscribe to that newsletter if you haven't done so already, just to stay abreast of the latest tools and guidance from the GHG protocol. And finally, there are also many, over 50 in fact, reporting programs based on the GHG protocol. We'll also talk about those programs shortly. Now, as I mentioned, the GHG protocol has published 6 standards on greenhouse gas accounting, and 4 of these standards pertain directly to companies, and I'll preview these standards on this slide. Those standards are the corporate standard, the value chain or the scope 3 standard, the product standard, and the project protocol. Okay. And each of these standards basically defines procedures for developing and reporting different types of GHG inventories. More specifically, the corporate standard and the scope 3 standard are for the development of corporate or entity level inventories. The product standard is for the development of product level inventories or product carbon footprints. And the project protocol is for the development of project level inventories. And I just want to spend the next few slides explaining these different types of accounting approaches, because it's important to distinguish what each of these different standards does, as well as understand how they map on to one another. Okay. So first, corporate or entity level inventories basically combine emissions data from across all of the company's operations. These inventories contain information on historical emissions so that they can be used to track reductions that have actually occurred compared to some prior year. And in contrast, when we talk of project level accounting, we're concerned with quantifying the future emissions reductions expected from individual projects. And these projects may have been established to reduce or to avoid emissions or to sequester carbon in forests, for example. Project level accounting is used to quantify the impacts of offset projects, for example, and under project level accounting, because we are looking at future impacts from projects, the emissions reductions are estimated through a comparison with some kind of hypothetical or baseline scenario. Okay, so that's project accounting in a nutshell. The third type of accounting is product accounting, and here a product inventory combines all of the emissions from across the life cycle of an individual product or service, regardless of whether those emissions have already occurred or will occur at some point in the future. So, for example, a product inventory will combine emissions from product manufacture, upstream and downstream distribution, the reuse and recycling of a product. And in contrast with project accounting, emissions reductions at the individual product level can be calculated by just comparing a product inventory with an inventory created for a prior year. So again, while the GHG protocol has published standards for the development of different types of inventories, the focus of this training is, of course, on the corporate standard, which is for the development of entity level or corporate level inventories. There is, however, some overlap amongst these standards, and specifically later on I'll talk about offsets and how offsets should be reported within a corporate inventory. I'll also talk about the overlap between the Scope 3 standard and the corporate standard. A core concept in the corporate standard is that of direct and indirect emissions and of the scopes. This is a somewhat famous graphic, and you'll become quite familiar with it over the course of the next few days. Without getting into the weeds here, the basic point is that emission sources can be grouped into different categories based on whether they are internal to the reporting company or whether they exist upstream or downstream of the company along its value chain. And those that are external to the reporting company are called Scope 3 emissions. Those that are internal to the company are called Scope 1 and Scope 2 emissions. Scope 3 emissions need not be reported under the corporate standard, and that's a point I'll come back to later on. An important point is that our standards are complementary, as I'll show in this slide. And together, the standards form a comprehensive framework for managing emissions. The corporate standard again covers internal emission sources, the so-called Scope 1 and Scope 2 emissions, and I'll spend some time today describing what Scope 1 and 2 emissions are exactly. In turn, the value chain or the Scope 3 standard covers the reporting of Scope 3 emission sources that are located upstream and downstream of the reporting company, and a company's combined Scope 1, Scope 2, and Scope 3 emissions is the same as the total amount of the life cycle emissions from each of that company's products. So, for example, all of the emissions from the production of those products would equal a company's Scope 1 and Scope 2 emissions. The The corporate standard is probably the most fundamental standard for greenhouse gas accounting and will often be first adopted by companies before they start more sophisticated types of accounting, such as product or project level accounting. And certainly companies will use the corporate standard before they use the Scope 3 or value chain standard. So the corporate standard is often the first step in a company's efforts in GHG accounting. So that's a fairly broad overview of the GHG protocol and its various products. We'll be delving into some of the topics raised in these slides throughout the course. The next slides and the first lesson of the series proper will provide more background information on the corporate standard itself. And just to answer one question that's come through, the question is, are product emissions also included in Scope 3 emissions? The answer is that yes. A product life cycle inventory will contain emissions data for sources that are located upstream or downstream of a company along its value chain. Okay, and those are called Scope 3 sources, and those Scope 3 sources would also be included within the product lifecycle inventory. That is not a concern in terms of double counting, because companies often would only report lifecycle inventories for a small subset of their product portfolio. Okay. So double counting isn't an issue, especially because we're dealing with different types of inventories and different accounting approaches. But we'll get into the nitty-gritty of that topic later on today when I discuss the organizational and operational boundaries that underpin a corporate inventory. But I think that should become clear too. I see a question relating to ISO standards and bilan carbone in France. That's a great question. I will address that question, but let me first of all provide some further context on the corporate standard, then I'll return to your question, but thank you for sending it through. Okay, so with that then, let me start the first lesson proper. Lesson 1 will be the overview of the corporate standard, then I'll give momentarily. The remaining lessons, lessons 2 through 7, review the main requirements in the corporate standard regarding how inventory should be prepared and publicly disclosed. The last lesson, lesson 8, will summarize all of the material we'll have covered in the preceding lessons. And these lessons will cover the key chapters in the corporate standard that contain requirements. Okay. There are other chapters in the corporate standard that contain only guidance and not requirements. I'll just reference these other chapters in passing because I really do want to make sure that we fully understand the core material in the standard, which is the requirements. Okay, so in this lesson, we'll cover a number of topics. We'll look at how and why the corporate standard was developed. We'll look at what the standard should and should not be used for. We'll look at how an inventory can bring value to businesses. And we'll look at how the standard interacts with voluntary and mandatory GHG reporting programs. So again, the corporate standard outlines requirements and guidance to help companies and a range of other organizations develop corporate or entity level inventories. It was first published in 2001 and then revised slightly in 2004. The first edition took 4 years to develop and involved the input of over 350 experts. And then the second edition involved the input of close to 500 experts. I think that points to the importance of stakeholder processes that underpin the development of all of GHG protocol standards. The corporate standard itself is now available in 7 different languages, including Portuguese, Spanish, Mandarin, Japanese, and Korean. And the corporate standard covers the accounting and reporting of 7 different greenhouse gases or classes of greenhouse gases. And just to be explicit, those gases are carbon dioxide, methane, nitrous oxide, nitrogen trifluoride, hydrofluorocarbons, perfluorocarbons, and sulfur hexafluoride. Okay. Not every company will emit all of these emissions, and later on tomorrow we'll look at the topic of which industry sectors tend to emit which greenhouse gases. But for now, it's sufficient to know that the standard covers the accounting and reporting of these 7 gases. The standard doesn't cover other gases that happen to be greenhouse gases, such as CFCs. And this is because these other gases are not yet covered by the UNFCCC, the United Nations Framework Convention on Climate Change. And in the case of CFCs, are covered by another UN protocol called the Montreal Protocol. And to answer a question, yes, these emissions are converted to CO2 equivalents before they're then reported and consolidated within a company's inventory. But don't worry, we'll cover the topic of how to convert emissions of individual gases to CO2 equivalents. And we'll do that during lesson 6 tomorrow on calculating emissions. Okay, so the standard was developed to serve 5 main objectives. One is to help companies prepare a true and fair account of their emissions. Another is to simplify and reduce the costs of compiling an inventory. And one way in which the standard does this is by basing some of its requirements on financial accounting practices. And that's a point we'll explore later on, particularly when we discuss the topic of organizational boundaries and revising what's known as a base year inventory to reflect changes in organizational structure. Other objectives of the standard are to help companies manage and reduce their emissions, of course, to help them participate in reporting programs, and more generally to increase consistency and transparency in GHG accounting and reporting. In terms of who should use the standard, the main audience is business, of course, but the standard is also perfectly suited for use by a range of other organizations that want to develop such inventories, including NGOs, government agencies, and universities, for example. The standard is also intended for organizations and policymakers that are designing GHG reporting requirements and reporting programs. Now, we've developed a range of sector-specific guidelines to supplement the corporate standard, and the standard was purposefully designed to offer quite a flexible and high-level framework that works across different sectors. And this design is one reason why the corporate standard in particular has seen such heavy adoption worldwide, but it also means that the corporate standard doesn't necessarily address certain key accounting issues that are specific to individual sectors. And so to help companies in certain sectors interpret the use of the corporate standard, we've developed a range of sectoral supplements. And the focus of these supplements is on sectors that present unique accounting issues that aren't addressed properly in the corporate standard, sectors that contribute significantly to global emissions and that at the same time offer significant reduction potential. And naturally, companies in these sectors must have expressed interest in additional guidance. So those are the general criteria we would follow in determining for what sectors we need additional guidance. To date, we've developed guidelines for the cement sector, the agricultural sector, the power sector, the government sector in the United States, amongst others. And just to make clear, the focus of these trainings is on the cross-sectoral requirements in the corporate standard. Despite that, I'll be very happy to answer any questions you might have about our sector-specific guidelines. So we do have the opportunity to discuss those during this webinar training. As I mentioned earlier, there are now more than 50 reporting programs worldwide based on the corporate standard, and this slide shows only some of those programs. There are programs on every continent, including multiple programs in North and South America, Europe, and Australasia. So some examples here include the GHG Brazil program, the Climate Registry in North America, and certain programs in Asia. The point here is simply that the corporate standard has been quite successful and forms the basis for virtually every GHG reporting program across the world, or at least every reporting program. Hi, I wonder if everybody could please mute themselves, please. Thank you. Okay. And the point here is simply that the corporate standard has been adopted wide world, and it forms the basis for virtually every GHG reporting program that operates at the corporate level. Okay, many of the world's largest companies are using the corporate standard, and we don't actively track the number of companies that use the standard simply because so many do. But just to give an idea of usage at the corporate level, the CDP has released some helpful data. The CDP, just for some context, the CDP is a non-profit organization that regularly surveys the world's largest companies to assess investment-related risks and opportunities connected to climate change. And based on their survey, it turns out that over 86% of companies in the Global 500 measure and report their emissions to the CDP using the corporate standard. And that 86% statistic comes from recent data, and certainly more recent than the 72% figure shown on this slide. So the real figure is over 80%, and that percentage figure is increasing all the time. Some of the companies that use the corporate standard are shown on this slide. So here we see a wide range of sectors represented, including the oil and gas sector, chemicals, retail, metals, food and drink. I also see banking, general industrial and manufacturing sectors. So a broad range of sectors. The point being that most sectors can directly use the corporate standard without the need for some kind of supplementary sectoral guidance. So why are all these companies using the corporate standard? In other words, what kinds of business goals do companies have in mind when they set out to develop their inventories? Well, there are many different business goals, but they can broadly be categorized into three types. In general, inventories can help companies understand operational risks and opportunities connected to climate change, such as exposure to GHG regulations, or inventories can help guide investment and procurement decisions, for example. A second class of business goals relates to tracking and reducing emissions. As I stated previously, inventories help companies identify emissions hotspots and reduction opportunities, set targets, and generally track progress over time towards those targets. And also, inventories can help companies report to their stakeholders and be responsive to their customer base. For example, inventories will help companies participate in voluntary reporting programs and generally improve corporate reputation and accountability. During this training, we're not going to delve into the business goals for developing inventories. Rather, our focus will be on the overall accounting and calculation processes that a company follows to develop inventories. Yes, Ludwig, I see your question, so let me answer your question right now. Hopefully you have a better appreciation of what the corporate standard is designed to do. And during the course of the trainings, we'll get a good feel for how the corporate standard supports the various kinds of business goals I mentioned. I do think it would be helpful to reiterate what the standard is not intended to do. It's not intended to quantify the reductions from individual GHG mitigation projects. And so here, if you remember, the reductions from these projects are calculated relative to some kind of business as usual scenario. If you want to calculate project level reductions in this manner, then you should use the project protocol. And similarly, the corporate standard isn't intended to help companies account for the life cycle emissions from individual products. And if that's an interest to companies, then they should refer to the GHG protocol's product life cycle standard. Okay. And just to further answer Ludwig's question, I mentioned a range of GHG reporting programs that are based on the corporate standard. And virtually all programs are compatible with the corporate standard, but it's worth making a few points here about our relationship with these programs, particularly as we get asked a lot of questions on that point. The GHG protocol is not itself a reporting program. We do not collect GHG inventories, and we also don't develop inventories for companies. Instead, there are many consulting companies that would fulfill that kind of role. The GHG protocol doesn't require the verification of inventories. A chapter in the corporate standard actually provides guidance on verification, but individual programs would have their own set of specific requirements about verification, and these requirements would vary according to the reasons the programs were established in the first place. So, for example, the verification, validation requirements of a mandatory reporting program might be more onerous than those of a voluntary program. The chapter in the corporate standard on verification is guidance material, which is why we're not going to cover it in this training. But if you do have any questions about verification, I'm very happy to take those. The next point is that the corporate standard was not designed for a particular program or policy. I think that last point touches on the broader issue of policy neutrality to help ensure that the corporate standard is relevant to as many users as possible. And finally, if you are participating in a reporting program, it's definitely worth checking the requirements of that program, because they may be more specific, or they may add additional requirements onto those already in the corporate standard. And I'll flag a few common examples throughout the course of areas or accounting topics where GHG reporting programs might add on more specificity to the requirements already in the corporate standard. Okay. So in summary, the corporate standard provides standards and guidance for preparing emissions inventories. The standard is primarily used by businesses, but it's also used by a wide range of other organizations. There are a number of reasons why inventories bring value to businesses. We're not going to concentrate on business goals today or during this course. Instead, the focus will be on the accounting mechanisms. And the standard is compatible with many GHG programs and policies. For further guidance on this topic, or for further introductory material, I'd refer you to the first chapter in the corporate standard. Okay. So a lot of questions have come in. Let me take some time now to answer them. Valeria brings up the subject of science-based targets and that they require GH protocol as mandatory for setting a science-based target. And yes, that is correct. Companies will need to follow the GH protocol corporate standard and perhaps also the Scope 3 standard to develop an inventory, and that's to ensure that their science-based target can be validated by an initiative called the Science-Based Targets Initiative. I can expand on what that initiative is later on during this training, but for the time being, the initiative is concerned with developing guidance and that supports companies in their efforts to set aggressive emissions reduction targets that are in line with 2-degree scenarios. And in order for a company to have its target registered and validated by the initiative, that target has to be based on inventories prepared according to the corporate standard and potentially also the Scope 3 standard. Likewise, the corporate standard is very much useful when completing the CDP survey. In fact, the CDP climate change survey contains questions that are matched to the reporting requirements of the corporate standard. We'll look at the reporting requirements of the corporate standard on day 3. But for now, it's sufficient to know that the CDP might ask for information on, does ask for information on Scope 1 and Scope 2 emissions, and for the 15 different categories of Scope 3 emissions. Okay, and the GHG protocol then obviously provides a framework for developing those emissions estimates. Yes, there will be breaks during this course. We do have a break scheduled for in approximately 30 minutes. We may take that break sooner than scheduled. But let me first of all walk you through or answer the remaining questions and walk you through the next lesson on principles. So there was a question about the ISO standard. The ISO standard is based on the GH protocol corporate standard. In fact, we collaborated with ISO quite closely in the development of their ISO standard. An inventory prepared according to the corporate standard is compatible with the requirements of ISO, so there's no need to be concerned on that front. There is one, I'd say, area of difference, and I'll come back to that in lesson 4 today on operational boundaries. When a company calculates the emissions from its electricity consumption, there are different ways to represent those emissions in an inventory. There are 2 ways possible under the corporate standard, and in most cases, companies will be required to report those 2 emissions totals in their inventories when using the corporate standard. For ISO, though, ISO only requires one method or one result, and it's optional to report the result from that second method. But don't worry, we will get into the nitty-gritty of those requirements later on today. For the time being, it's important to know that the 2 standards are very similar. ISO standard is based on the corporate standard, and there's one major difference which I'll come to later on today. We have a question regarding NOx, nitrogen oxide emissions, or nitrous oxide emissions. Those are not the same as N2O emissions, and so the requirement under the corporate standard is to only report N2O emissions. Obviously, a company is free to report emissions of other greenhouse gases if it wants to do that, and it would do that in what's called a memo item of its corporate inventory. Okay. So the only requirement in the corporate standard is to report the emissions of the 7 greenhouse gases or classes of greenhouse gases I mentioned earlier. Those emissions would be reported in the main body of an inventory under the scopes, and emissions of any other gases can be included in an inventory on an optional basis, and if they are included, they'll be reported in a memo item, okay, outside the scopes. That's another topic we'll be turning back to later on. Okay, so I don't see any other open questions at the moment. So let's dive into the second presentation, which is on principles. Now, so just to answer your question, yes, when reporting the 7 gases, it will be necessary to convert all of them to a CO2 equivalent basis. And we do that using something called global warming potential values. Okay. Lesson 2 covers the quite fundamental topic of GHG accounting and reporting principles. This will be a relatively short lesson, and we'll take a break after it. The following lessons cover the technical accounting and reporting steps involved in constructing an inventory, and will be much more involved and include exercises. So this lesson on principles will be relatively short. We'll then take a break, and then we'll start what I think is the meat of GHG inventory accounting, which is setting inventory boundaries. In this lesson, we'll cover the 5 principles that guided the development of the corporate standard, and that also guide how companies should prepare their own inventories following the corporate standard. The 5 principles are relevance, completeness, consistency, transparency, and accuracy. And I'm just going to spend a few moments on each principle because they are so fundamental, and because it's important that any inventory strike an optimal balance amongst these principles. Okay. So the first principle is relevance. In other words, GHG inventories must contain information that internal and external users need for decision making. And what this means in practice is that inventories should be designed to reflect such aspects as company characteristics, stakeholder needs, organizational structures, and general business context and relationships. That might sound a little general at the moment, but we'll illustrate this principle throughout the trainings, especially in the context of organizational boundaries and revising base year inventories to reflect changes in organizational structure. The second principle is that of completeness. In other words, companies should make a good faith effort to provide a complete accounting of their emissions. And in practical terms, the principle of completeness means that a company should account for all emissions within their chosen inventory boundary. And if some emissions have been estimated insufficiently, then that fact should be documented and justified. An important point here is that the corporate standard doesn't allow emissions to be excluded from inventories just because the emissions are relatively small. And rather, the idea is that all required emissions should be included in inventories, and we'll touch on that topic in lesson 4 later on today. But briefly, one reason why it's important not to exclude small sources is that these sources might become more important in the future. So, to an example, here a company, Ford, has conducted an inventory in 2006 and determined that the emissions from production processes only accounted for a small percentage of its overall emissions. But in a subsequent inventory period, in 2012, it determined that these emissions were proportionally much more important. And so the basic point here is that in adhering to the completeness principle by regularly reassessing emission sources over time, Ford was able to develop more complete and relevant inventories that are more useful as a basis for emissions management. The third principle is consistency. Consistency is important because comparable data are needed to track emissions performance over time. And in order for inventory practices to be consistent, companies have to do a number of things. They have to consistently apply the same inventory boundaries and calculation methods and general accounting approaches over time, and they have to document and justify any changes to those approaches in their inventories. The fourth principle is transparency, and what this means is that emissions data must be disclosed in a clear and factual manner to allow users to have some confidence in interpreting the reported data. And various things help make an inventory transparent, and these include maintaining a clear documentation and archives or audit trail. Again, disclosing and justifying exclusions is important. Companies also need to provide references for methodologies they've used and the data sources for the activity data they've used to calculate emissions. And it can also help to secure the external verification of an inventory. That's not required under the corporate standard. The corporate standard doesn't require that inventories be verified, but it's a recommended step to help further ensure transparency if that's a concern of a company. The fifth and final principle is accuracy, and here there are 3 crucial points. The data reported in an inventory should be credible enough to be useful in decision making. Inventory calculation should be systematically neither over nor under actual values, and sometimes that is a risk given the types of emission factors that companies use. We'll cover that issue in lesson 6 tomorrow. And also, uncertainty should be reduced as far as possible. Okay, so those are the 5 overarching principles that should guide the development of inventories. And I think it's worth pointing out that companies may encounter trade-offs between principles when completing inventory. And trade-offs are, in fact, quite likely, and they are particularly likely to occur between the principles of accuracy and completeness. So in particular, a company may find that achieving the most complete inventory requires using less accurate data, which then compromises overall accuracy. Okay, so let's take an example of that. Here, a company, The Body Shop, has collected data on energy consumption for shops located within shopping centres. And its challenge is that these data on energy consumption have been estimated with relatively high uncertainty, yet excluding the estimated emissions from energy use from its inventory would lead to an incomplete inventory. And the question is, what's the solution? How can Body Shop resolve this tension between accuracy and completeness in this case? In general, Identifying and resolving these trade-offs is an important part of improving the quality of inventories. In this case, the body shop could have done one of two things to resolve the trade-off and improve both the accuracy and the completeness of its inventory. It could have directly monitored store energy consumption, or alternatively, it could have used some sectoral guidelines to estimate the emissions based on store size and equipment data. So it could have used default industry average emission factors to calculate the emissions, or it could have used energy consumption monitors to generate its own primary data and then calculate the emissions directly. Okay, so in general, the general function of the principles is to help ensure that inventories represent a faithful, true, and fair account of a company's emissions. And these principles are, again, relevance, completeness, consistency, transparency, and accuracy. We'll have a lot of exercises during the course of this training, so there'll be plenty of occasions to think about how the principles are applied in practice and about the potential trade-offs that may occur amongst them. In fact, I do encourage you to keep these principles in mind as we go through the lessons, and just to think about what they may mean in practice in terms of how your organization constructs and reports an inventory. In terms of further reading, more information on the principles can be found in Chapter 1 on Accounting and Reporting Principles. Okay, and so we've reached the end of that lesson. Let me take some questions and we'll take a short break. Companies do make adjustments for historical reporting errors, for errors in their inventory, and that's a key issue. If those adjustments are significant, then it could be necessary to recalculate the base year inventory. Excuse me. So it can be necessary to recalculate what's known as the base year inventory to restate the emissions, essentially, and to ensure that the company is tracking performance in a meaningful way. We will look at that issue in depth tomorrow when we discuss the topic of tracking emissions over time. It's an important issue to address. This training will not provide or will not cover the agricultural guidance that the GH protocol developed for the agricultural sector. Again, the focus of these trainings is very much on the core requirements in the corporate standard that apply across sectors. However, if you do have questions about the agricultural guides, I'd be more than happy to answer them. There's a question regarding the body shop example. Yes, I can send through to the group some links to calculation methods that the body shop could have followed to estimate the store's emissions using default emission factors. Okay. And later on in this webinar training, we will look at various calculation tools, including those developed by the GH protocol to estimate emissions. But I'll also cover some sources of other kinds of emission factors and methodologies that companies can use. So I'll return to that topic later on. Collecting data, activity data, is very much an important component of developing an inventory, of course, and is often the most time-consuming part. We do provide some guidance on collecting data, and I will also send some links to that guidance. That guidance isn't in the corporate standard itself, it's in a number of separate publications, but we'll send through links to those publications, and we'll do so by the end of today. Yes, Cindy, and just to clarify to the entire group, the next training is on Thursday, so there's no training tomorrow, but on Thursday. I said Wednesday as a force of habit, but I meant Thursday, so thank you for pointing that out. And Elena, yes, you can please send directly to me any questions on the agricultural sector guidance. And just to let you know, of course, this training only lasts 3 days, but if you do have any questions about this material or about corporate inventory practices in general, please do feel free to send questions to me, and I'll answer questions for the next couple of weeks following this webinar trainings. So you do have that option. No need to ask all questions during this training. You do have an option of reflecting on the training materials, thinking a bit more about how they apply to your own company, and then coming back to me with further questions. Okay.
Seeing a few questions here about people not being able to see the other questions that have been submitted by others. So I'm going to work on trying to see if we can make those visible for everyone in the audience. So thanks for that feedback. I will look into it now.
Okay, thanks, Yelena. One more question. There's a question around data sets for emission factors. And emission factors come in many different forms. So for example, if we look at the emissions from the combustion of a fuel, some emission factors might just be for the emissions from that combustion. Certain other emission factors might include some of the life cycle emissions involved in the production and transportation of that fuel prior to combustion. And other emission factors might include these life cycle emission phases in addition to the combustion phase. So data sets will vary in terms of the number and the range of life cycle phases that are covered by the emission factors. Sometimes they will cover only cradle to gate emissions. So in our case of a fuel, a cradle to gate emission factor would be a factor that covers the emissions from the production of that fuel all the way to to just before the combustion of that fuel. So the point is that data sets will vary, and it's important to be mindful of that when you actually select an emission factor, to make sure that you know which life cycle phases are reflected in that emission factor. One reason why that's important is it's important to avoid double counting the same unit of emissions across an inventory and across the scopes within an inventory. And we'll come back to that topic later on. We have a great question around the connection between ethics and principles. Let me read it out to you. Since the group doesn't have access to the questions, let me read these questions out. And the question is as follows. Business or organizational ethics would be important to the GHG accounting and reporting principles. How do businesses and organizations make real, concrete connections between ethics and the principles? Do some include ethics officers on teams doing the GHG inventory in a business or organization? That's an intriguing question. The answer is no, ethics officers are not involved, but typically a company's inventory would be prepared by one unit within the company and would then be validated by another unit within that company. So companies would typically establish a fence around the GHG inventory preparation, and that's to help ensure adherence to the principles in the corporate standard. Okay, so no further questions at this time, and we are bang on schedule. So let's take that allotted 10-minute break, and we'll be back at 1/4 the hour, okay? So I'll set a timer here, and I'll be back in 10 minutes, okay? Thank you, everyone. Okay, our 10 minutes is up, and so let's get stuck into lesson 3, which covers the topic of organizational boundaries. And guided by the principles, this is essentially step number 1 in doing an inventory. So a very important step and one of the most elemental in developing an inventory. In this lesson, we'll cover a number of items, including how to determine which of a company's operations should be included in an inventory. We'll look at the 2 approaches for making that determination and why a company might choose one approach over another. To start off with, I think it's useful to think of inventory boundaries as a whole, as imaginary lines that encompass the emissions to include in a company's inventory. And the 2 main types of inventory boundaries. The first are organizational boundaries, which determine which activities or operations to include in inventories. And the second are operational boundaries. So once you've set the organizational boundaries and you then know which parts of the corporate structure will be included in the inventory, operational boundaries then determine which of the specific emission sources associated with those operations should be included in the inventory. Okay, and also operational boundaries determine how emission sources should be categorized within inventories, and specifically how they are divided up into the scopes. Operational boundaries are the subject of the next lesson, so a lot more about them later on. For the rest of this lesson, let's concentrate on organizational boundaries. Now, as I mentioned, organizational boundaries determine which operations are owned or controlled by the reporting company and what fraction of the emissions from those operations should be included in the inventory. And the importance of organizational boundaries really stems from the complex structure of many organizations. For example, many companies consist of subsidiaries, joint ventures, or franchises, and organizational boundaries will establish a consistent method for accounting for the emissions from all of the components of an organization. I note that generally the more complex the corporate structure, then the more important setting organizational boundaries becomes. And conversely, in companies with a very simple corporate structure, say a sole proprietorship, in such companies, the manner in which organizational boundaries are set may have little bearing on the final estimated total emissions from that company. Nonetheless, regardless of corporate complexity, organizational boundaries must always be set. Okay? That's a fundamental requirement in the corporate standard, that companies have to set their organizational boundaries using one of the two approaches I'll describe in this presentation. So here's an example that highlights why organizational boundaries are critical. Let's take a company called Global Cement Inc. that has 3 business operations in different countries: Phil Cement, Cementeros, and National Cement Co. And each of these units tallied their emissions using the corporate standard and arrived at the totals shown here. Phil Cement emitted 10,000 tons, Cementeros 5,000 tons, and National Cement Co 1,000 tons. These emissions were then rolled up to the parent company, for a total of 16,000 tons. And the question here is whether that 16,000 ton figure is reasonable or appropriate. At this stage, we don't know. For example, let's say that 50% of the middle unit, Cementeros, is owned by another company. So in that case, would the global parent company still continue to report all of the emissions from Cementeros for a total of 16,000 tons, or would it only report 50% of the emissions from Cementeros for a total of 13,500 tons? Okay, so there's some murkiness here. We're not sure what the right answer is. And to add a little more complexity, what if that other company controlled all of the operations of Cementeros in addition to owning 50% of Cementeros? So in this case, would the global parent company report half of the emissions from Cementeros for a total of 13,500? Or indeed, would it report any of the emissions from Cementeros at all? Perhaps it would completely exclude the emissions from Cementeros for a total of 11,000 tons. So that really is a fundamental question. And the basic point is that the overall emissions of the parent company depend on how it has set its organizational boundaries. And let's look at how companies set those organizational boundaries. There are 2 main approaches to doing so. We call these approaches consolidation approaches because they are means to combine or consolidate data from separate operations. The corporate standard identifies 2 approaches: the equity share approach and control approach. And within the control approach, companies have 2 options for setting their organizational boundaries. They can use either financial control or operational control. And an important point is that a company cannot use a mixture of these approaches in developing any one inventory. Rather, companies have to select a single approach and then apply that approach consistently across their entire structure, at least when developing any one inventory. But companies can develop different inventories using the different approaches if they wanted to. Doing so is entirely optional under the corporate standard, but developing multiple inventories using the different approaches can help companies understand the full climate impact of all of their business operations. And later on in this lesson, we'll look at why companies might want to use one approach over another. Valeria asks which approach is the more reliable, and there's no clear answer to that because the choice of consolidation approach really depends on a firm's own business context and the reasons why it wants to develop an inventory in the first place. We'll look at some considerations in choosing a consolidation approach later on in this lesson. So what we'll do now is we'll look at each of these consolidation approaches in turn, starting with the equity share approach. Using the equity share approach, companies account for emissions according to the equity share they hold in a given operation, regardless of who actually controls that operation. This is conceptually a relatively straightforward approach, and here are a few examples to illustrate it. Say an organization owns 50% of an operation, it must account for 50% of the emissions from that operation under the equity share approach. In this case then, the company would account for 50% of the emissions from factory A, or 500 tons. Likewise, if the company held 85% of the equity in different factory, factory B, it would account for 85% of the factory B's emissions under the equity share approach, or 850 tons. Okay. That's equity share in a nutshell. Turning to the control approaches, when using the control approach, companies have to account for 100% of emissions from operations that they are deemed to control, using either the so-called financial or operational control criterion. Each approach is applied separately, so a company can't develop a single inventory using a mixture of the two approaches. They can only use financial control, or they can only use operational control to develop any one single inventory. And this control approach is totally independent of the equity share approach. The rationale for the control approach is that many businesses are owned by another company and in turn may own other companies. But those ownership relationships don't likely play into the daily decisions made at a given company. Instead, certain actors or units actually have the control over finances or operations, and the control approach is intended to reflect that side of reality. To put that point a bit differently, a company may have an economic interest in an operation, but if the company does not exert operational or financial control of the operation, then the emissions from the operation are excluded from the inventory under the control approach. And to reiterate a point, if an operation falls under a company's control, under financial or operational control, then 100% of the emissions from the operation would be accounted for by the reporting company in its inventory. And conversely, if control isn't exerted, then none of the emissions would be accounted for. Okay, so we have generally a binary all or nothing decision here. There is one exception, and we'll tackle that in a second. But generally, we're dealing with a binary accounting rule where either 100% or 0% of the emissions are accounted for under a control approach. Let's look at the financial control approach in a bit more detail. And here, a company exerts financial control if it has the ability to direct an operation's financial and operating policies. If the company does in fact exert financial control, then it would again account for 100% of the emissions from that operation. And conversely, if financial control is not exerted, then that operation should be entirely excluded from the inventory. So in this case, the company would account for all of the emissions from factory A, but none of the emissions from factory B, because factory B does not fall under the financial control of the reporting company. Now, there is this exception to this all or nothing rule, and this exception relates to non-incorporated joint ventures or partnerships where the partners have joint financial control. In this case, the reporting company would account for a percentage of the emissions from the venture based on its percentage equity share in that arrangement. Okay, we'll see an example of that later on, but for the time being, it's important to know that we have a general all or nothing binary accounting rule. The only exception to that rule comes under financial control when accounting for non-incorporated joint ventures or partnerships, and in those cases, financial control defaults to an equity share approach. Again, we'll see an example of that later on. One question that commonly comes up with regard to financial control is how can a company determine if financial control is actually exerted? And in broad terms, it's possible to assess financial control by looking at corporate voting rights and the accounting treatment of a given operation in the parent company's or the reporting company's financial statements. The second control criterion is operational control, and here a company has operational control if it has the ability to introduce and implement its own operating policies. And oftentimes a company can determine who exerts operational control by finding out who controls or who holds the operating permit for the facility in question. And again, we have this binary accounting rule, and in this case, under operational control, there are no exceptions to this binary accounting rule. It's always all or nothing under operational control. And I think it should be emphasized that having operational control doesn't mean that a company necessarily has the authority to make all decisions concerning an operation. For example, big capital investments will likely require the approval of all the partners that have joint financial control. And so what operational control simply means is that a company has the authority to introduce and implement its own operating policies. Let's have a quick summary of the consolidation approaches, and then I'll tackle the questions that have come in. Under the equity share approach, a company accounts for a percentage of the emissions from an operation according to its share of equity in that operation. And under either of the control approaches, a company accounts for 100% of the emissions from operations over which it is deemed to exert control. And none of the emissions from operations over which it does not exert control. The only exception relates to joint ventures or partnerships under the financial control approach, where the reporting company has joint financial control, and in those cases, the accounting defaults to equity share. Okay. So shortly, I'll have some basic examples to illustrate the application of these approaches. First of all, let me take some questions. Again, the two control approaches cannot be combined. They must be applied separately when developing any one inventory. So an inventory, if it's prepared using a control approach, must be prepared only using operational control or only using financial control. The emissions from the raw materials that a company purchases and then consumes are oftentimes a very significant portion of a company's Scope 3 inventory. When you look at Scope 3 accounting, Scope 3 emissions are often dominated by two types of Scope 3 sources. One is the use of sold products, so the use of products that the reporting company has sold to consumers. And the second category is purchased goods and services, including the emissions from raw material acquisition and processing. Those emissions from raw materials would be reported under Scope 3, under a Scope 3 category called purchased goods and services. I'll talk more about Scope 3 in the next lesson on operational boundaries. But for the purposes of developing an inventory according to the corporate standard, it's not necessary to report those raw material emissions because they fall under Scope 3, and Scope 3 is optional under the corporate standard. Nicholas raises a good question, which is, what if we have operational control but produce for another company as well as for ourselves? Do we only count the share of our own products? In that case, no. You would count the emissions from all production occurring on that site. If you have operational control of that site, you would report all of the emissions tied to all production occurring on that site. You would make a distinction based on which company gets what share. You'd account for all of the product emissions. Now, somebody brings up the important question of accounting for leased spaces or rental space. That is an important question, and under the corporate standard, whether the emissions from leased space fall under scopes 1 and 2 versus scope 3 depends on two things. The accounting depends on the consolidation approach used and on the type of leased assets. So it depends on whether a company is using operational control versus equity share or financial control, and it depends on whether the leased asset is a finance or a capital lease. So that there is some intricacy there in understanding the accounting arrangements. We will look at that in the next lesson on operational boundaries, okay? Because when we discuss leased spaces, we are talking about scopes 1, 2, and 3 in more detail, and I think it'd be useful to have a bit more introduction and context around what the scopes are first before tackling the issue of accounting for leased spaces. And indeed, as Maximo points out, each method does give a different result. Each consolidation approach does generate a different result. And a lot of care and consideration needs to go into selecting a consolidation approach. I will have an exercise illustrating the different results from application of these different methods that I think illustrates that point quite nicely. There are many considerations that go into selecting an approach, and it's not possible to say that companies should use one approach over the other. Really, the answer is context dependent and depends very much on a company's own reasons for developing an inventory in the first place and its own overall context and business structure. I'll provide an overview of some of those considerations just shortly. But suffice to say, the operational control approach is the most commonly used approach. Companies do report when companies report to the CDP, they do report the consolidation approach that they've used, and that's another way in which the CDP survey is based on the corporate standard. I remember analyzing, I think it was 2015 CDP data, and of the 1,400 companies that indicated which approach they used, 80% of those companies use operational control. Sorry, 70% used operational control. A further 20% used financial control, and the remaining 10% used equity share. So equity share is the least used, but there are some considerations, important reasons why a company might elect to use equity share over the other approaches. For example, equity share is more commonly used in the oil and gas sector, where the asset ownership structures are quite complicated and where it can make more sense then to use the equity share approach. And Quentin, you are quite right. The choice of consolidation approach can change the results a lot. That will lead to non-comparable results if the company changes its consolidation approach from time to time. Sometimes companies do that. But if they do, they would need to recalculate their base year inventory so that they can more meaningfully track progress towards any reduction targets they've set. And this is certainly an area where we recommend that a company is fully transparent about the methods it's used. If a company has changed its consolidation approach, then it certainly should report that in its inventory. And indeed, if companies use different approaches, then the same unit of emissions might be double counted under the same scope. So the same unit of emissions might be in scope 1 for one company using operational control, but it might also be scope 1 for another company using equity share. And that's true. Double counting is a possibility in that case, but the way organizational boundaries are structured, double counting won't occur if companies use the same methodology. In this case, I'm not concerned if double counting occurs as long as there are valid reasons for companies to select different consolidation approaches, which there typically are. And Maximo, to answer your question, companies have to set the boundaries of their inventories following only the approaches in the corporate standard. There is some overlap with financial reporting processes. So if you recall at the beginning, I mentioned that the corporate standard is based on part on corporate and financial accounting and reporting practices to ease the burden of reporting greenhouse gas emissions data. This is one such example. A company can choose to report using equity share and financial control, which are more aligned with the general accounting approaches that a company will use for preparing its financial reports. Okay, Heather raises an interesting question. Her question is, TCR, the Climate Registry, which is a voluntary reporting program in North America, the TCR has discussed introducing control boundaries at the Climate Leadership Conference, specifically a Scope 3 credit or commodity relating to goods, services for agriculture that can be offered as a REC. Will the corporate standard introduce something similar? I'm not sure what methodology the TCR is following in this case. There is an ongoing effort led by an organization called the Gold Standard to develop accounting guidance for so-called interventions that occur in companies' supply chains. So if we look at a food and beverage company as an example, that company will procure goods, agricultural goods, from a set of farmers. But oftentimes the reporting company has no visibility as to which farmers it's procuring from, okay? And so, but nonetheless, the reporting company, the food and beverage company, is still working with its supplier base, or it's introducing projects in a given area to help reduce emissions from agricultural production. And it doesn't know offhand whether those reduction projects will directly benefit its own suppliers or the suppliers of some other company, because it doesn't have that visibility. It cannot trace its sourcing to the farm level. So in that case, one possible solution is to follow what's called a supply shed concept, whereby a company can account for emissions reductions that occur within the same sort of geographical region, as long as it implements a project in that region and as long as it's sourcing production from that region. So I think that supply shed concept is something that certainly the TCR has been working on. And that concept is something that the GHG protocol is currently looking at, and we're working with the gold standard to assess it and to assess it and see whether it can be adopted into the corporate standard. So in short, we are looking at the issue, but there's no firm guidance at the moment. We would expect guidance to be developed by the end of this year, so do stay tuned for that. Jesse asks a good question. In the example of the global cement company, do companies and joint ventures coordinate how they're going to report and coordinate what consolidation approach will be used? Often the answer is yes. We would recommend that companies sort of enshrine those reporting requirements and responsibilities in a contract, if only to help avoid the double counting of emissions. Antonio asks a good question, which is, how do we account for consignment warehouses? For example, we do not have operational control, but we can require certain conditions be met, like temperature control. And does that count as implementing policies? Good question. In this case, it would not. Really, a company can determine whether it holds operational control by seeing whether it has ownership or whether it holds the operating permit for that facility. If it doesn't, then it doesn't hold operational control, even though it may have some influence over the types of policies that are present in the facility. But if it doesn't have that operating facility permit, then it doesn't have operational control. Okay, so let's turn to the remainder of this presentation. And we'll turn to a number of basic examples to illustrate the application of these consolidation approaches. We will have more involving examples in the exercise immediately following this lesson, but for now, let's just concentrate on the basics. Okay, so here a company has 25% equity share in factory A. And the question is simply, what emissions from factory A would the company account for? I'll give you a second to think about that. And the answer is simply 25% of 1,000 tons or 250 tons. That's for equity share. For financial control, the company has financial control over factory A, and so in this case it would account for all of the emissions from factory A, all 1,000 tons. But the company does not have operational control over factory A, and so it would not account for any of the emissions from factory A under operational control. Let's turn back to our original example of global cement and consider what its emissions would be under the different consolidation approaches. Here, consider that global cement has 1,000% equity share and operational financial control over Phil Cement. It has no operational control over Cementeros, but it does have financial control over Cementeros and 50% equity share in Cementeros. And finally, it has 100% equity share and operational and financial control over National Cement Co. So what are the emissions from global cement under each of the different consolidation approaches? Well, under the equity share approach, we would count all 10,000 from Phil Cement, plus half of the 5,000 from Cementeros, and all of the 1,000 for National Cement Co. So the answer is 13,500 under the equity share approach. Financial control is different. The parent company has financial control over each of these operations, and so its overall emissions would be the full 16,000 tons under the financial control approach. And for operational control, the parent company has operational control over Phil Cement and National Cement Co, but not over Cementeros, so its total emissions would then only be 11,000 tons. So far, we've provided a fairly simplified treatment of how organizational boundaries should be set, but there are more complex situations such as accounting for leased assets and more complex operating structures such as franchises, group companies, non-incorporated joint ventures, etc. In the next lesson, we'll review the accounting for leased assets, and the corporate standard has a lot more guidance on how to account for these other more complex operating structures that you see on this slide. I do want to turn back to the topic of double counting while setting organizational boundaries, because that's already come up in our conversation and it is an important issue. It's often asked whether the boundaries based on consolidation approaches, whether the boundaries entail double counting, especially in cases of joint ownership or control. And the answer is that yes, double counting can occur, but that the risk of double counting can be mitigated in various ways. As I mentioned before, the reporting company should always apply the same consolidation approach in any one inventory. And this avoids double counting the same unit of emissions within a single inventory. Also, joint owners of an operation should strive to use the same consolidation approach, because otherwise they may be over or under counting the emissions from that operation. So joint owners should strive to use, say, the equity share or the financial control approach. And in terms of joint ventures, companies should ideally draw up contracts to specify emissions ownership. That's to help avoid ambiguity around reporting responsibilities. Now let's get back to the topic of which consolidation approach should a company actually use. And the answer depends on many factors related to the business objectives of the company in developing an inventory. But some of these factors are shown on this slide. One factor is reflection of commercial reality. The equity share approach might be most beneficial here since it most closely reflects the company's commercial reality. Another factor is influence over emissions reductions, and here having operational or financial control over a business unit is an important factor in the amount of influence that the company wields over emissions reductions. And so a company might prefer one of the control approaches for this reason. In terms of program and regulatory requirements, most government regulations use operational control as a basis. That's particularly for facility level reporting. However, GHG reporting programs may require one of the other consolidation approaches, and that's certainly something to be mindful of. In terms of risk and corporate responsibility, here the equity share approach is most closely aligned with financial risk management, and so might be favored if one wanted to focus on financial risk in particular. For alignment with financial accounting is done by both equity share and financial control, so either approach will be compatible with the financial accounting practices already used by a company. For management information and performance tracking, here it's considered that the control approaches are best suited to tracking performance. And in terms of administrative costs and access to data, companies with operational control are more likely to have access to the necessary data for preparing an inventory, and so they might prefer operational control for that reason. And finally, the last consideration we've listed here is completeness of reporting. The most complete reports use both equity share and one of the control approaches. That is, a company would develop two inventories, one using equity share and the other using a control approach. And I've reserved this point for last because, as you can see, there are many different factors that go into choosing a particular consolidation approach. And one approach may not fully reflect the climate impact of an organization. So while the corporate standard requires companies to use only one approach in a given inventory, some companies do choose to prepare two inventories based on the equity share approach and one of the control approaches, just to give a more complete picture of their climate impact. Again, that's not particularly common when we consider that only around 10% of companies actually use the equity share approach at all. And somebody asked me to repeat which approach is best for financial risk, and the corporate standard considers the equity share approach is most closely aligned with financial risk management. And so we would recommend the equity share approach if risk and corporate responsibility and liability is a particular concern for companies. Okay, let me turn to the summary and then I can answer any remaining questions. There are four main takeaways from this lesson. One is that organizational boundaries determine which parts of the company are included in the inventory and at what percentage. Organizational boundaries can be based on equity share and on one of the control approaches. Total emissions can vary significantly depending on which consolidation approach is used. And so it's really imperative for companies to think carefully about which consolidation approach makes most sense to them given their own environment and business context and objectives for reporting emissions data in the first place. Okay. There is one remaining question which asks, how would you account for co-packers for a food and beverage company? I don't know quite what a co-packer does exactly, but if it's a separately organized entity, then the emissions from that entity would be accounted for under scope 3. So if it's a packing company that packs for this food and beverage company and packs for other companies, the emissions from that co-packer would be reported under scope 3, but you'd only account for the emissions from the reporting company's own products that are packed. Okay. For further guidance on organizational boundaries, you should turn to Chapter 3 of the Corporate Standard. That should be the first reference point. In addition to the corporate standard, there are two other reference documents. One is the ISO standard 14064 Part 1. The ISO specifications are almost entirely based on our corporate standards, so inventories prepared according to the corporate standard will be fully compatible with the ISO standard. And for further reading, you could also turn to a publication called Hot Climate Cool Commerce, a service sector guide to greenhouse gas management. And this last publication is essentially an abridged version of the guidance and requirements in the corporate standard that has been specifically designed for smaller service sector based companies. Okay. So let's turn to the next item on the agenda, which is the training exercise for lesson 3. I'll give you a minute to get that document. It looks like this. So it's a Word document that's entitled 3 Setting Organizational Boundaries. The reading materials I mentioned, Valeria asks where can we download the further reading materials. Those materials can be downloaded from the geopolitical website. At least the corporate standard can be downloaded from the geopolitical website, as can the Hot Climate Cool Commerce publication. The ISO standard is not available from the GH protocol website, and to access that document, you'd have to purchase it from ISO itself or one of its national bodies. But all GH protocol materials are freely available from the GH protocol website. So Peter has an accounting question. Let me read it out to you. If we have a mother company that owns factory A, which produces goods for daughter company B and C, whereof daughter company B is responsible for all of the operations, how should daughter company B account for the emissions? Okay, so the facility in question produces goods for a daughter company, daughter companies, and one of those daughter companies owns the facility, okay? Sorry, controls the operations of that facility. In this case, if daughter company B has operational control over that facility, it would account for the emissions from that facility under operational control, okay? But the daughter company B doesn't have financial control, it doesn't own the facility, and so it wouldn't account for any of the emissions under the financial control approach. So the answer is that the accounting would vary depending on which consolidation approach was used. Okay, so hopefully you've all had a chance to download this document, and hopefully you have it in front of you. Let's go through it now. And this exercise essentially consists of two cases. In each case, I'll walk you through the question, and I'll give you some time to arrive at an answer before then explaining my answer to you, and we can have a general discussion as needed if you have any questions. Let's take question one, and here we're considering company Z, which has 5 facilities over which company Z exerts varying amounts of control and different amounts of equity share. So you can see that company Z only fully owns one of the facilities, facility C. It has operational control of facilities B, D, and E, and it has financial control of facilities C and D. And essentially what we're asking you to do here is to complete the total corporate-wide inventory for company Z under each of the different consolidation approaches, under financial control, operational control, and equity share. I'll give you a few minutes to do that on your own. While you are doing that, please also consider question 2, which asks, what do you notice from this table about the 3 different approaches? Can you think of any situations when it would be advantageous to use one approach over the other? Okay, so if everyone, could you please have a crack at questions 1 and 2, and I'll be back within a few minutes to provide my answers to question 1. Okay, thank you, everyone. Okay, let's have a look at the answers to question 1. And I'm not going to go into the derivation of these values in any detail. If you have any questions, please let me know. The answers are as follows: a total of 6,000 tons under the financial control approach, 8,000 tons under the operational control approach, and 4,115 tons under the equity share approach. And just to let you know, we will be sending out the full answer sheets at the end of each day, so you will have the full answers to this exercise by the end of today. Of course, the noticeable thing about these results is that they differ greatly from each other, almost by a factor of 2. And the basic point of this exercise then is to emphasize that a company should really carefully consider its objectives for undertaking an inventory before selecting a consolidation approach. The emissions are greatest under the operational control approach, and as we discussed earlier, it might make sense for a company to use the operational control approach if it were participating in a government reporting program, or say if it wanted to hold managers accountable for activities under their control, or if it wanted to avoid the higher administrative costs that are being incurred using the other approaches. On the other hand, a company might prefer to use the equity share approach if it felt that that approach offered a better reflection of commercial reality or of liability and risk management. Again, if the financial control and the equity share results are lower, so if a company did opt to use either the financial control or the equity share approach, it might also want to consider developing a separate inventory using the operational control approach. Let's turn to the last question in this exercise, question 3. And here we are concerned with Alpha, which is a company with a complicated organizational structure. The legal, ownership, operational, and financial characteristics of each of these operations is outlined in this table. And what we're asking you to do is essentially to fill out the last 3 columns to specify the percentage of each operations Alpha would include in its inventory under each of the 3 organizational boundary approaches. Okay, this is a more involving exercise, so I'll give you a longer period of time to do it. Okay, and I'll leave the table on the screen, so you can refer to the screen directly if you prefer. So again, please take a crack at the last question, question 3, and within a few minutes I'll come back with my own answers. Okay, thank you everyone. In the meantime, if you do have any questions, please do feel free to submit them. Thanks all. Okay, let's take a look at the answers. And do rest assured, you will all have the training materials, including the PowerPoints and the completed exercise answer sheets for self-study at the end of each day. Let's take each of the operations in turn, starting with beta. This is relatively straightforward compared to the other cases in this question. For beta, alpha would account for 100% of the emissions from beta under the operational control, financial control, and equity share approaches. The case of gamma is also somewhat straightforward, hopefully. Alpha has operational control of gamma, and so would account for 100% of the emissions from gamma under the operational control approach. Gamma is a subsidiary of alpha, and so alpha would also exert financial control over gamma and account for 100% of the emissions under financial control. But alpha has only 40% equity in gamma, and so would only account for 40% of the emissions from gamma under the equity share approach. Okay, looking at delta. Delta is controlled operationally by Epsilon, a different company, and so alpha would not account for any of delta's emissions under the operational control approach. Alpha has 50% equity stake in delta through beta, which is a wholly owned subsidiary. This means alpha would account for 50% of the emissions from delta under the equity share approach. And delta is a joint venture between beta and another company called Epsilon. As we discussed, under the corporate standard, joint financial control of joint ventures is treated the same way as equity share, so alpha accounts for 50% of the emissions from delta under the equity share approach. Okay. Turning to pi. And here it gets a little more complicated. The operating policies of pi are controlled by gamma, which is a subsidiary of alpha. So alpha has operational control over pi. And the same is true of financial control, because pi is a subsidiary of gamma. And alpha would account for 100% of the emissions from pi under financial control. But in terms of equity share, 75% of pi is owned by gamma, which is in turn 40% owned by alpha. So we multiply 75% by 40%, we get 30%. Alpha accounts for 30% of the emissions from pi under the equity share approach. Okay, let's turn to the last case, that of omega. Operational control of omega is held by a new company called Lambda, so alpha doesn't account for any of omega's emissions under the operational control approach. Alpha has 56% of the equity in omega, and so would account for 56% of the emissions from omega under the equity share approach. And in terms of financial control, omega is an incorporated joint venture and is a subsidiary of alpha. So hence here there is no joint financial control, and alpha is assumed to have 100% financial control of omega. Okay, so the accounting got a little convoluted at times, but hopefully this was useful exercise in thinking through how the boundaries are applied in practice. If you have any questions, please let me know. We will be sending around the answer sheets later on, and if it's useful, I can type up a longer answer to this question. We only have the percentage values on this table, but I can type up a narrative explanation for why or how we arrived at these answers. Okay, so let's look at pi, and there is a request to repeat the justification for pi's equity share of 30%. So let's do that now. And if we look at pi, %75% of pi is owned by gamma. And then if we look at gamma, we find that 40% of gamma is owned by alpha. So to do the accounting for pi, we need to multiply 75% by 40%. And that's how we get the 30% figure. In other words, 40% of the 75% is actually accounted for by the company. Okay, let's look at financial control for pi. I will happily repeat the justification of financial control for pi and omega. If we look at pi, pi is treated in alpha's financial accounts via gamma, which is a subsidiary. Okay. And indeed it says here that pi is a subsidiary of gamma. And so that then we can infer that alpha has financial control over pi and would account for 100% of the emissions from pi in its inventory. Return to omega. This time omega is an incorporated joint venture. Okay. And is a subsidiary of alpha. This means because it's an incorporated joint venture, there is no joint financial control, and alpha is assumed to have 100% financial control of omega. And Mandy asks if a company is a subsidiary of another company, as an example of omega, in relation to alpha, does that mean they have 100% financial control? The answer is yes. So if a company is treated as a subsidiary of the parent company, then we assume that the parent company has 100% financial control. Okay. So I think we've concluded this lesson number 3. Let's turn to the last lesson of the day, which is lesson 4 on operational boundaries. And if we have time, we may also do the exercise for lesson 4. That is scheduled for Thursday. As originally, we would typically do it the day after today, of course, but since we've postponed the trainings to Thursday, I think it would make sense to cover that exercise today if we have the time. Okay, so there are three fundamental steps in designing an inventory. The first is setting the organizational boundary, the second is the operational boundary, and the third is setting a base year inventory and recalculating that base year inventory to ensure consistent tracking of performance over time. This lesson will cover the second step in that sequence, which is setting operational boundaries. In this lesson, we'll cover which sources of emissions to include in inventories and the difference between so-called direct and indirect emissions. We'll also look at how we classify emissions under the so-called scopes and how the concept of scopes really is instrumental in preventing the double counting of emissions by different organizations. And finally, we'll look at how to classify the emissions from leased assets and other selected business activities under the scopes. As we saw in the previous lesson, boundaries are, or can be thought of as imaginary lines that encompass the emissions to include in a corporate inventory. There are two types of boundaries: organizational boundaries, which determine the specific business operations that should be reflected in an inventory, and then operational boundaries. Operational boundaries build on organizational boundaries to determine which specific sources should be included in an inventory and how those sources should be categorized within the inventory. Let's take a quick example. Here, in this example, the organizational boundaries of the parent company would determine the companies named A to D that need to be reflected in the inventory. Operational boundaries, in turn, add more specificity to boundaries by looking at the specific sources associated with each company, such as a shipping or car fleet, building, or some other installation, and then determining whether and how those sources should be reported in an inventory. To help set the context, let's quickly review why setting operational boundaries is so important. And operational boundaries are important because they help companies do four things. They help determine which sources of emissions to include in inventories. They help the classification of sources to avoid double counting the same unit of emissions by different organizations. They provide more useful information to stakeholders, including internal management and investors. And they help manage GHG risks and opportunities along the value chain. And a lot of the material in this lesson and the associated exercise will demonstrate these advantages. So hopefully they'll become clear to you by the end of this lesson. Setting operational boundaries involves three discrete steps. Okay. The first is identifying the emissions associated with a company's operations. The second is categorizing the emissions as direct or indirect. And the third is further categorizing each emission source into one of three scopes. So let's assume that the reporting company has robust information on the emissions associated with its operations. Its next step is to determine which of these sources are direct and which are indirect. And by the way, in lesson 6 on Thursday, we'll take a look at the types of emission sources commonly associated with different kinds of businesses. So you'll be in a position to help answer the first bullet point here, which is to identify emissions associated with operations. But for the time being, let's assume we know those emission sources. Our next step is to classify emissions as direct or indirect. So let's consider the following simple value chain. Here we have a reporting company, which is the factory, that sources power from the grid and that contracts from a maintenance company. And the question here is which of the emissions from factory production, power production, and transportation are direct and indirect for the reporting company, for the factory. Direct emissions are emissions from sources owned or controlled by the reporting company. And so the emissions from factory production would be direct for the factory. In turn, indirect emissions are a consequence of the activities of the reporting company, but occur at sources owned or controlled by some other company. And here then, the emissions from power production and the transport vehicles belonging to the maintenance company, those emissions would be indirect for the factory. Once we know which sources are direct and which are indirect, we could then classify the sources by scope, and only 3 scopes are defined for greenhouse gas accounting. All direct emissions are automatically classified as scope 1 sources, with the exception of the CO2 emissions from biomass, and we'll come back to that point later on. And indirect emissions are either scope 2 or scope 3. So let's take a closer look at each of the 3 scopes, starting with scope 1. So again, scope 1 emissions are direct emissions, meaning they come from sources that are owned or controlled by the reporting company. And scope 1 emissions are principally the result of the following types of activities undertaken by a company. Actually, let me rephrase that. Emission sources can be divided up into 4 categories, as shown on this slide, and whether any of these categories falls under scope 1 really depends on the organizational boundary approach used. Okay? But in general, emission sources are grouped into these 4 categories. These are stationary combustion, so that's the combustion of fuel to generate electricity, heat, or steam. The second is physical or chemical processing, and most of the emissions result from the manufacture or processing of chemicals and materials. So examples of physical or chemical processing emissions would be the emissions from cement calcination, from cement production, the emissions from aluminum production, and the emissions from waste processing. The third category is transportation. Here we're concerned with the emissions from the combustion of fuels in company-owned or controlled mobile combustion sources, such as trucks, trains, ships, airplanes, etc. And then finally, we have fugitive emission sources. Fugitive emissions result from uncontrolled or unintentional releases, such as the release of methane from coal mines and natural gas transmission and distribution systems, or maybe the HFC emissions from the use of refrigeration and air conditioning equipment. Okay, so those are common examples of fugitive emissions. Under the corporate standard, all scope 1 emissions have to be reported in an inventory. So if an emissions source is scope 1, then the emissions have to be reported regardless of which category it falls under, regardless of whether it's a mobile combustion source or a stationary combustion source or a fugitive source, etc. Logan asks, would a mobile source such as a lawnmower count towards scope 1? And the answer is technically yes, if that emission source would fall under scope 1. As I said earlier, companies should not exclude emissions from their inventories just because they suspect that those emissions are small. Rather, the recommendation is to calculate the emissions from all sources. And companies can follow a simplified estimation approach for sources that they believe to be small. In this case, if for example, we're dealing with a single lawnmower, then no, it would fall under scope 1, but it wouldn't make sense to include it within the inventory. We have a question from Marina, and the question is, are the transportation emissions from the transportation of employees to their companies from their houses, are those emissions included in scope 1 emissions? So the question is, are the emissions from employee commuting included within scope 1? The answer is no, they're actually included within a separate category in scope 3 that's entirely, solely for employee commuting. Okay, because the assumption is that companies will use public transit systems, or they might use their own vehicles to travel to and from the workplace. If, however, the firm actually provides transportation, so for example, Google might provide transportation for its own employees, then those emissions would actually fall under scope 1, but otherwise the emissions from employee commuting would fall under scope 3. A related question comes from Nicholas, who asks about the transportation of materials, products, and waste and employees. If you see the third line on this slide, yes, the emissions from transportation would fall under scope 1 if that transportation is provided by vehicles owned or controlled by the reporting company. Quinton asks, if a firm leases its vehicles, are the emissions scope 1 or scope 3? That's a good question. We will look at the accounting for leased assets later on in this presentation, so I'll defer answering that question just for a few minutes, but we will definitely get back to it. Thank you. Nicholas asks, what about the logistics of materials from suppliers to our factories? And so that transportation, those logistics related emissions would fall under scope 3, okay? If your company is paying for those logistics services, then the emissions would fall under a scope 3 category called upstream transportation and distribution. Okay, but if some other entity is paying for them, then that fall under downstream transportation and distribution. Antonio asks, if we don't control any of the transportation, for example, we deliver via FedEx or other couriers, do the transportation emissions fall under scope 1? And here, no, that the transportation emissions would fall under scope 3. And that's because the reporting company doesn't own or control any of the transportation vehicles. Somebody asks for further explanation on how one would calculate chemical or physical processing emissions and provide specific examples. Good question, and there are typically no standard approaches for that. The approaches are customized to the chemical or physical process concerned. I will provide an example tomorrow on Thursday in lesson 6 on calculating emissions, okay? Different types of estimation approaches exist. Most commonly, companies would use emission factors, or they might use what's known as a stoichiometric or mass balance approach, and either approach can be used to calculate the emissions from chemical or physical processing. I will return to that point on Thursday during lesson 6. So we will be looking at specific examples there. We have a request to restate what fugitive emissions are. And yes, fugitive emissions basically are uncontrolled or unintentional releases of greenhouse gas emissions. And typically those releases are dispersed over a wide geographical region, okay? So they're typically and often not point sources, although they can be. So some examples of fugitive emissions are the emissions of methane from coal mines and natural gas transmission and distribution systems, or the emissions of refrigerants from the use of refrigeration and air conditioning equipment. Axel asks whether Scope 1 includes the consumption of goods during the course of normal business. And some examples of goods listed are papers and pens. Well, the purchased goods and services, such as papers and pens, the emissions associated with the production of those goods will be reported under Scope 3. And if we're looking at papers and pens, technically there are no consumption emissions associated with those goods, so that no consumption related emissions would be reported under Scope 1. So I hope that's clear. Lee asks, this is in relation to fugitive emissions, if the releases of greenhouse gases are uncontrolled, how would you calculate or quantify the impact? And yes, you're right, one way to calculate the impact is to track the amounts of refrigerants you're using to top back up refrigeration and air conditioning equipment. And that is a specific calculation approach that we'll be using in the final inventory lesson on day 3, okay? So one way to calculate the releases of fugitive emissions is to track the amount of refrigerants you're using. Oftentimes, though, for other kinds of emission sources, it is possible to use default emission factors. So, for example, a non-gas company would use default emission factors that describe, on average, how much emissions are released by certain transmission and distribution equipment. Damien asks for examples of physical or chemical processing. And so, yes, I think examples here would come from essentially any industrial process. Examples would include the production of cement, another example, which releases carbon dioxide. Another example would be the release of high GWP gases from aluminum production. Still other examples would include the production of other high GWP gases from chemical production. So the examples are varied, but they do occur in high energy intensive industrial sectors. Eric asks a good question. I'll just read it out to you. And this is in the context of a supplier sending products to a customer. If the supplier accounts for the transportation as Scope 1 emissions, and the customer accounts for the transportation as Scope 3, is this double counting? My answer is that it's a form of double counting that you should not be concerned about. Scope 3 accounting inevitably entails some degree of double counting, and we'll look at that more closely later on in this presentation. But if the same units of emissions are included in Scope 1, if the same unit of emissions are included in the Scope 3 inventories of different companies, then that's fine. Now that's unavoidable and is in a sense an integral part of Scope 3 emissions accounting. But, and to return to your example, if the emissions are included as Scope 1 in one company and Scope 3 in another, that's totally fine. That's probably as it should be, because what's Scope 1 or Scope 2 for one company will inevitably be Scope 3 for another company. Okay, let me carry on with the presentation here because I'm a bit mindful of time. If I don't have time to answer your questions, please rest assured I will do so by email today, or I'll answer them at the beginning of Thursday's presentations. Okay. So that's Scope 1. Let's look at Scope 2, which is a bit more involving. Scope 2 emissions are the emissions from the generation of purchased energy, purchased electricity, steam, heating, and cooling that has been consumed by the reporting company and that has been generated at a source that is not owned or controlled by the reporting company. For many companies, purchased electricity represents one of the largest sources of GHG emissions and the most significant opportunity to reduce emissions. And that's particularly true for office-based organizations, but many other types of organizations as well. As with Scope 1, all Scope 2 emissions must be included in corporate inventories. And now, of course, companies can reduce their Scope 2 emissions in several ways. On the demand side, they can reduce energy consumption through energy conservation and efficiency improvements. On the supply side, they can reduce their emissions by changing the source of energy production. And they could do that perhaps by installing on-site renewable energy or by purchasing electricity products that confer a lower emissions profile. And it's on that last point, the purchase of low carbon electricity products, that I want to spend a few slides on. There are a wide array of such low carbon products, and their availability very much depends on the electricity market in which a company operates. So some examples of these products include things like supplier-specific programs or labels such as the green power programs offered by local utilities. Other examples are energy tracking certificates, which may be issued to record the generation of renewable energy. And common examples of such certificates are guarantees of origin in Europe and renewable energy certificates, or RECs, in the United States. And a further example of these kinds of differentiated electricity products are, or can be, power purchasing agreements, which are contracts that allow a consumer, and typically a large industrial or commercial entity, to form an agreement with a specific energy generator. And so the question for many companies has been, how can purchases of these products be reflected in my company's inventory? What I'll do now is spend 5 minutes or so on that question and describe how new GH protocol guidance helps you answer it. This guidance is the GH protocol scope 2 guidance, and the general impetus for developing that guidance is the fact that quite significant changes have occurred in electricity markets worldwide, and the recognition that these changes are not adequately captured in the revised version of the corporate standard, which was released in 2004. So these changes include the deregulation of electricity markets, alongside more government requirements for sourcing renewable energy, and these changes have led to growth in renewable energy markets, including new purchasing options and products such as RECs, and a concomitant increase then in consumer choice. Historically, there has been a lot of confusion and inconsistency amongst companies in terms of how they report the impacts of these new products on their scope 2 emissions totals. To give a few examples, previously some companies, and particularly companies in the US, adjusted their scope 2 emissions by using an estimate of the avoided fossil fuel emissions from the grid associated with their purchases of renewable energy. So in other words, they attempted to use a project-based accounting approach to estimate the displaced emissions from fossil fuel generation, and then subtracted those emissions from their scope 2. It's a form of avoided emissions accounting. Other companies instead treated their purchases as essentially emission factors conveying a zero emissions rate in scope 2 calculations. And still other companies treated participation in green power programs effectively as a donation with no impact on the GHG inventory. So there has historically been a variety of accounting approaches to scope 2 and to accounting for these differentiated electricity products. And that's made it difficult for a company to consistently account for and report scope 2 emissions across multiple countries. And it's led to a lack of consistency and transparency across the inventories of different companies. And so it's precisely this inconsistency then that the new guidance aims to address. I think at this point, it's helpful to think about two types of electricity markets. One is a market that does not provide product or supplier-specific instruments. And this type of market is summarized in this graphic. Here, power is generated and sent via a utility to the consumer. And the consumer has no choice over its electricity supply. It simply acquires its energy from the grid. The other type of market is one where consumer choice exists, where consumers have the ability to choose amongst different products or supplier-specific programs. And this graphic will illustrate this second type of market. There are two parts to this diagram. The bottom part depicted here represents the physical flow of electricity from a generator, here wind, into a grid and then onto the consumer. In parallel to this physical distribution of electricity, there are systems for tracking attributes of the electricity that has been generated. And these systems issue certificates to record what type and how much electricity of a certain type has been produced. And they effectively allow consumers to make claims about what they have contractually purchased. These certificates can be bundled or unbundled with contracts for energy flow. So they can be sold together with the electricity, for example, in an energy contract, or they can be unbundled from the underlying electricity and then sold separately from that electricity. And either way, the certificate flows either to the utility, which uses that information for consumer disclosure, for example, to validate the green portion of a label or a tariff, or in some markets, that certificate can flow directly to consumers, particularly large industrial or commercial consumers. So this is a system where consumers can source energy from the grid and at the same time enter into contracts with suppliers for specific electricity products or certificates that convey a different emissions profile from that of the entire grid. Hopefully that helps set the context, and let's get back to our earlier question, which is how can consumers reflect the emissions profile of these products or certificates in their Scope 2 inventories. And the Scope 2 guidance outlines two general methods for doing. So it outlines two general methods for calculating Scope 2 emissions. These are the location-based and the market-based approaches. The location-based approach reflects the average emissions intensity of grids on which energy consumption occurs. And this method is applicable to all electricity grids. And many companies have in fact been using it for some time through the use of what's called grid average emission factors. These grid average emission factors are defined for broad geographic locations, including local, subnational, or national boundaries. And we'll look at some examples later on. So that's the location-based approach, which is based on grid average emission factors. In turn, the market-based approach reflects emissions from electricity that companies have purposefully chosen. Okay? And it calculates Scope 2 emissions based on certificates or contractual instruments such as RECs, or on purchases of electricity that have been bundled with contractual instruments. Okay? So in other words, the market-based approach is intended to capture the emissions profile of these other differentiated low-carbon electricity products that companies have purposefully purchased. An important point here is that the market-based approach isn't applicable to all markets. It's only applicable to those markets that provide consumers a choice of differentiated electricity products. I'm not going to go into the nuts and bolts of how the two methods actually work. Instead, I'll defer that discussion to lesson 6 on Thursday. But for the time being, it is important to know the pros and cons of the two methods. In general, the location-based method is advantageous because it reflects actual generation and distribution occurring within the grid system. But at the same time, using grid average emission factors, there's really no incentive to reflect purchases or to influence supply. The only means of reducing Scope 2 emissions is via consumption. So the only means of reducing Scope 2 emissions is simply to consume less electricity. And the location-based approach is less relevant for making purchasing decisions, for example, for making decisions about whether to purchase a PPA or a renewable energy certificate, for example. In turn, the market-based method is advantageous because it better reflects risks and opportunities associated with supplier portfolios, because it captures the emissions profile of differentiated electricity products that the company has purposefully chosen. And as such, it's more relevant for making purchasing decisions. One potential disadvantage of the market-based method, though, is that voluntary purchasing may not impact the market. So if a company were to purchase renewable energy certificates, that may not incentivize the generation of additional new renewable energy production. Okay. But nonetheless, there are certain quality criteria that these differentiated products must meet before they can be reflected in a market-based Scope 2 total. Those quality criteria are discussed in some length in the Scope 2 guidance. I'm just going to read a paragraph out to you from the Scope 2 guidance, which describes what the quality criteria are intended to do. They relate to the integrity of contractual instruments as reliable conveyors of GHG emissions rate information and claims, as well as the prevention of double counting. They represent the minimum features necessary to implement a market-based method of Scope 2 accounting. Okay, so any differentiated electricity product must meet these quality criteria before they can be reflected in a market-based Scope 2 total. And they are intended to ensure that the instrument concerned or the differentiated product is robust and can meaningfully be applied to the Scope 2 total. We'll look at these criteria later on in day 2, but for the time being, it's important to know that these quality criteria exist and that instruments have to meet them before their own emissions profiles can be reflected in a market-based Scope 2 total. Daniel asks, do companies have to report location-based and market-based emissions? In practice, most companies will have to, and I'll get into that topic right now. It's important to know that the Scope 2 guidance requires that these methods be used in specific circumstances. For companies that have operations that only exist in markets where these differentiated products are not available, for these companies, they only have to report one Scope 2 total based on the location-based approach. So if a company only operates in jurisdictions where these differentiated products are not available, it only has to report a location-based total, so one Scope 2 figure. On the other hand, if a company operates in a market that does provide these differentiated products, where it has the option of purchasing these products, then it has to report two Scope 2 totals, one corresponding to the market-based method and the other corresponding to the location-based method. Okay. And there's an important nuance to be mindful of here. A company may operate in a market where this choice is available, but instead, and it elects not to purchase these differentiated products. Even so, even if a company doesn't purchase these products, it still has to report a market-based method, in addition, market-based Scope 2 total, in addition to a location-based Scope 2 total. Okay. Let's turn to the final scope category, which is Scope 3. This category includes all other indirect emission sources. Naturally, when you think about it, Scope 3 is a broad category that includes sources such as the emissions from transport vehicles that are not owned or controlled by the reporting company, or say the energy consumed in the manufacture of goods purchased or of goods purchased by the reporting company. Scope 3 sources are optional. They don't need to be included in corporate inventories under the corporate standard, although they may be required by some GHG reporting programs. That's an important point to be mindful of. In general, though, it is important to consider Scope 3 because Scope 3 provides an opportunity to be quite innovative in GHG management and to tackle what are often the bulk of the company's emissions. For most companies, over 80% of emissions are from Scope 3 sources, so it is important for companies to address them. In thinking about Scope 3, companies may want to focus on reporting those activities that are relevant to their business and goals and for which they have reliable information. An important point is that since companies have discretion over which categories they choose to report, Scope 3 doesn't lend itself well to comparisons across companies. Okay. One Scope 3 figure from one company is not going to be comparable to the total Scope 3 emissions figure of another company, because they may have different operating structures, different corporate structures, and they may be reporting different types of Scope 3 activities. So Scope 3 really does not lend itself well to comparisons across companies. Okay, this slide summarizes the discussion so far on scopes. Here we see the 3 scopes and the types of emission sources that would typically belong to these scopes for any one company. The corporate standard requires that companies report emissions in each scope separately, and also only the emissions of these 7 gases should be included in the scopes. But just because gases other than these 7 can't be reported in the scopes, that doesn't mean other gases can't be reported at all. Companies can report information on other greenhouse gases outside the scopes in a so-called memo item, and we'll come back to that specific point in lesson 7 on day 3. Another exclusion, so one exclusion from the scopes, is the emissions of greenhouse gases that are not any of the 7 greenhouse gases shown on this slide. Another exclusion concerns the CO2 emissions from biomass. And if we look at the biomass cycle, biomass carbon cycle, we find that during photosynthesis, of course, plants remove carbon as carbon dioxide, but not nitrous oxide or methane. They remove that carbon from the atmosphere and store it in plant tissue. And until that carbon is cycled back into the atmosphere, it resides in one of a number of carbon pools. These pools include above ground biomass, below ground biomass, dead organic matter, and biomass-based products such as food products. So because the CO2 emissions from biomass combustion are sequestered during subsequent biomass growth, the GHG protocol requires that these CO2 emissions not be reported within the scopes, but that they should instead be reported as a memo item. In contrast, the nitrous oxide and the methane emissions from biomass combustion should be reported within the scopes because these gases are not sequestered during subsequent plant growth. Okay. At this stage, I think it'd be useful to reiterate a particular point. When a company is drawing its operational boundaries, it doesn't draw those boundaries based on the type of emission source. So, for example, it does not decide the operational boundary based on whether it's looking at stationary combustion or fugitive emission sources. And rather, it draws its operational boundaries based on whether it owns or controls each specific source for business operations that fall within its organizational boundaries. So in other words, to determine if an activity falls within scope 1 or 3, a company would refer to the consolidation approach it chose to set its organizational boundaries. And what this means is that an activity might be scope 1 for a company under one consolidation approach, but then scope 3 for that company under a different consolidation approach. Now, as I hope you've begun to appreciate, together the 3 scopes provide a comprehensive framework for managing and reducing both direct and indirect emissions. The sum of a company's entire Scope 1, Scope 2, and Scope 3 emissions should approximate the sum of the life cycle emissions of each of that company's products. And these life cycle emissions would come from upstream, downstream, and internal operations, such as those shown on this slide. Okay, we have 10 minutes. I think that may be just enough time then to finish the presentation. Let's take a minute to run through a simple exercise and test our understanding of the scopes in relation to 4 hypothetical cases. I'm going to ask you to review this slide for a minute and think through how each of the actions taken by companies here would impact their emissions under each of the scopes. So think about each of these 4 actions, and I'll be back in a minute with my thoughts. Okay, so let's take a look at the first action here. The company has installed a new thermal power plant on site, so it no longer needs to purchase power from the grid. What are the impacts on Scope 1, 2, and 3? Scope 1 emissions will increase because the stationary combustion source is being brought within the corporate boundaries. Scope 2 emissions will decrease because the company is no longer reliant on grid electricity. And the impact on Scope 3 is a little nebulous, it's a little uncertain. The impact on Scope 3 depends on a couple of considerations. One is the extent to which the company is reporting Scope 3 in the first place. So depending on which Scope 3 categories and sources the company is reporting, there may be no change in reported Scope 3 emissions whatsoever. Perhaps a more fundamental point is that the impact on Scope 3 also depends on the upstream emissions associated with power production. So if the upstream emissions from the grid electricity production were higher than those related to the power plant, to the construction and operation of the power plant, then actual Scope 3 emissions would fall. It's an actual impact. And conversely, if the upstream emissions from grid electricity production were less than those associated with production, construction, and operation of the power plant, then Scope 3 emissions would increase. Okay. So the basic point here is that the impact on Scope 3 really depends on a comparison of the full value chain impacts of the 2 decisions. Okay. And to answer that question, you may have to look upstream of the power plant and understand the emissions associated with each option. So let's turn to the second case. Here, the company purchases a new vehicle fleet instead of outsourcing transportation services. I'm going to assume no electric vehicles are involved here. Scope 1 emissions will increase because the emission source is being brought within the corporate boundaries. There's no change in Scope 2 because, again, I'm assuming no electric vehicles. And again, the impact on Scope 3 is a bit nebulous, and it depends both on the extent to which the company is reporting Scope 3 emissions and on a comparison, or it depends on the relative magnitude of the upstream emissions associated with each option. Okay. Likewise, for the third action, here a company installs a new on-site solar power generation plant to replace grid electricity. I'm going to ignore construction-related emissions here for Scope 1. There's no change in Scope 1 emissions if we ignore construction-related emissions. Scope 2 emissions will fall because the company is less reliant on grid electricity. And the impact on Scope 3 is a bit nebulous. There are upstream Scope 3 emissions associated with the construction of the solar power plant. Okay. For example, the sourcing of the various raw materials that went into making that power plant. And there are also Scope 3 emissions associated with the generation of grid electricity. So, for example, the production and transportation of fossil fuels to the generation sites. And the impact on Scope 3 then will depend on the difference in these upstream emissions. In the fourth action here, a company installs energy efficient lighting at its facilities. Here, there is no change in Scope 1, but there is a decrease in Scope 2 emissions because the company is consuming less electricity. And the impact on Scope 3 depends on the upstream emissions associated with either option, with the sourcing of raw materials, with the manufacture of these lighting products, and the transportation of these products to the company in question, to the reporting company. And we might also want to look at downstream Scope 3 emissions as well. So perhaps energy efficient lighting products emit more in the disposal and recycling phases, in the end of life phase. And so that would impact Scope 3 emissions as well. So the overall point of this slide is that the impact on Scope 3 is often uncertain and depends on a complete accounting of impacts along the value chain. The GHG Protocol has developed a separate standard that provides a lot more guidance on how to develop comprehensive inventories of Scope 3 emissions. This standard takes you through each of the different steps in developing a Scope 3 inventory, including describing the value chain, determining which categories are relevant, identifying value chain partners, and then quantifying the emissions. And I am mindful of the time. We are now pretty much at hour. I do have one other topic that I want to discuss with you, and that's the accounting for leased assets. And we do also have an exercise on operational boundaries. So what I propose to do is to continue the rest of this presentation on Thursday. And I think that'll be useful in jogging our memory. I'll provide a recap of all the material we've covered in this lesson before we enter into the training exercise on Thursday as well. So I do note that there are a number of questions, perhaps 12 open questions. And what I'll do is I'll either answer them individually by email, or at the beginning of Thursday, okay? So before we go, I'd just like to thank you for your time and interest today. It's been great working with you. I really do appreciate all of these questions and look forward to an equally active Thursday. So thank you very much for your time and attention. I look forward to speaking with you more on Thursday. Thank you all.